So I was wrong about Opendoor. In this video, I'm going to share Opendoor's earnings report and conference call, as well as share a few things that I got wrong. I just talked about this company a few days ago, and with earnings out, I decided that it was a good idea to share what I thought about the company's earnings, but also the housing market as a whole. But I don't want to waste your time, so let's go ahead and dive right in. When we look at the real estate market, it has gotten really tough out there. Mortgage applications are near relative lows, home sales have plummeted, and the question going into this earnings report was how badly was Opendoor going to do? And let me tell you that there were a few things that I was extremely surprised about. But first, let's go ahead and look at the numbers. The company expected to have revenues cut almost in half from the previous quarter to between 2.2 billion and 2.6 billion. And I think many people expected the company to either just be in line with expectations or miss given the drop in home sales. But the company actually reported $3.4 billion, which is up 48% from the previous year. Now, even though this may seem like great news that the revenues beat estimates tremendously, it's important to know that they took a hit in order to reach this revenue number. What Opendoor did is accelerate their home sales by cutting their home prices. This means that they did lose money on a decent amount of their homes. And this is going to be important when I start talking about their guidance for Q4. There is a term that they use to define the older inventory called the Q2 offer cohort. This inventory has much lower spreads than their newer inventory, so their margins aren't as good. And this leads to adjusted EBITDA, or earnings before interest, taxes, depreciation, and amortization. They expected to have adjusted EBITDA in the range of negative 125 million and negative 175 million, but my estimate was a greater loss closer to negative 200 million. Well, because they sold more homes to get rid of their older inventory faster, their adjusted EBITDA was worse than my estimates at negative 211 million. Now, it's important to note that the newer inventory didn't have as much of an effect this quarter as it will when we get into Q1 of next year. So this quarter had really poor margins, and it will continue going into the following quarter. Now, the reason for this is very important in my opinion. Without even thinking about what is going on in the current housing market, Q4 is always a tough quarter when it comes to sales. So when you include the fact that home sales have fallen drastically, this is going to be an even tougher quarter, which could push home prices down. So rather than needing to pay more on the debt of these houses, they would rather take the losses and get rid of this inventory so that the homes they now have on their inventory have better potential margins. Looking at their Q4 guidance, here's what they have reported. Revenues are expected to be between 2.3 billion and 2.5 billion dollars. Now, this is going to be dependent on a couple of factors. First is how much of their Q2 offer cohort they will be able to sell. They're expecting to sell close to 65% of this inventory. If they're expecting home prices to decrease much more than they initially guessed, then they might want to sell more of this inventory, which could increase the revenue, but again, destroy their adjusted EBITDA, which their guidance for this upcoming quarter is not good. They're expecting adjusted EBITDA to be between negative 335 million and negative 355 million dollars. Now, they did say that they're anticipating the contribution profit to bottom in Q4, which is nice to see. Think about it this way. Opendoor is expecting home prices to decline going into 2023, and because they have been extremely conservative with their numbers, they are able to get ahead of the curve and have decent margins going forward. And to help them improve on their margins, they have reduced operating expenses drastically quarter over quarter. In Q3, they had operating expenses in line with their guidance at $190 million. For Q4 though, they are expecting to reduce that number to $145 million. But going back to the Q3 numbers, there was one thing that I was not pleased with, and that was the conversion rate. In their Q1 report, they had a conversion rate of 35%, and unfortunately, that was not what we got for this earnings report. The CEO said that their current true seller rate was between 10 to 15%, so that's not even close to what they had before. But the reason for this reduction is important. The company is trying to protect themselves and their margins, so they have increased the spread levels so they can buy the house cheaper. This will help them, especially when we get back to a more stable market. And speaking of their margins, they have introduced a new product that I believe will help the company get more revenue to the bottom line. Opendoor has always had what is called their first party business, which is where the company buys homes from one party and then does minor repairs so that they can sell it to another party. But now their new product, which is their third party business, allows Opendoor to be the middleman between the buyer and seller without needing to actually buy the home themselves. This way, they are involved with the transaction, but the consumers of this product can transact directly with each other. This will make the process much more quickly in comparison to the traditional process, and there is complete transparency on both sides because there is only one company involved in this transaction. So earlier in the year, they started the buyer side of this marketplace format, which I've talked about previously called exclusives. Now they have just opened the seller side. This will expand their audience because rather than Opendoor only buying certain kinds of properties, buyers can list their properties that are outside of Opendoor's buy box. And so they only have to be involved in the transaction of the home. What I found interesting in the conference call is that the team continued to allude to investors buying homes with Opendoor. They are confident that with investors and the amount of homes that are bought through Opendoor exclusives, they are aiming for 30% of total transactions to come by way of this business in 2023. And this is important because this is a much more profitable side of the business. But there was one thing that I definitely did not expect, and that was how bad their days on market was. In Q2, they reported 5% of their homes were on the market for 120 days. However, this quarter, that number increased to 21%, and that was higher in comparison to the overall market. Now, I do believe much of this was because of the decrease in the overall demand, but especially the investor demand. However, a major reason that they mentioned for the increase in percentage is because their homes are skewed to longer dated homes because they reduced the amount of homes acquired. Onto the balance sheet, the company continues to have a solid capital position. As of September 30th, the company had $11.8 billion in borrowing capacity and 70% is committed. So a good amount of this is obligated by the lenders despite the crazy market that we're in. Plus, it's important to note that even in October, Opendoor is still getting financing through increasing capacity on an existing facility from $750 million to $1 billion. So this gives me confidence that the company will be able to get through this rough time. On top of this, the company has $1.5 billion in cash and cash equivalents and $1.5 billion in equity for their homes. They are planning on financing $349 million, and that will give them an even stronger cash position to start buying homes, which is important, especially if you believe that the housing market is going to bottom out in the next year. The next metric that I was paying close attention to was their contribution margin. This is really telling of how the company is going to do in a lower transaction market. They have been around 4 to 6% in the last couple of years, but this past quarter, they had margins of 10%. Over the long term, they're expecting to get up to 7 to 9% total contribution margins. But this quarter was not good. They had a negative contribution margin of 0.7%. So I was definitely wrong with these numbers, as I was still expecting them to be positive. However, when we look at their projected contribution margin for the year, despite these massive macro shifts in the housing market, they are expecting to be at 3.5%. Now, one thing that had many investors nervous was the write-off of $573 million for inventory valuation adjustment. This is what contributed to a gross loss. And of course, this was going to be brought up in the conference call. It's important to clarify that this was not a revaluation in their portfolio. This is a projection that the company has to make in order to recognize losses. And as these homes with losses are sold, this adjustment will align with homes that are expected to generate realized gains. So this pulls the losses forward and allows them to get this tough time over with. But it's important to note that they have taken a conservative view on this adjustment. So unless these home prices fall even further from their current stance on the housing market, then they are well prepared to withstand the housing pressures. And the last thing that I wanted to look at is how their market share is doing. In this past earnings report, they said that they are now in 51 markets. And even though they haven't expanded into new markets, they have added new products into these markets. For example, it was reported that they have launched their marketplace in Dallas, Fort Worth, and Austin with Opendoor exclusives. This is a massive market, so this could be telling over the upcoming quarters for how their third-party product will do in a difficult market. So overall, I would give this earnings a C. It was not awful, as I believe they are making smart moves by selling their low-margin inventory at a fast pace, but that doesn't mean that there were some tough numbers to look at. So in terms of what I want to do with this company, I had to ask the question, will this company get through this difficult housing market so that they can get back to profitability? I believe they will, and so what I will be doing is only adding shares to keep my percentage of the portfolio. So this is probably going to be my smallest add, especially given the fact that I'm starting a new position in Shopify, which if you haven't seen that video yet, I'll post it right here. If you're new here, hit that subscribe button. That way you're notified when new content comes out. Hope y'all enjoy the rest of your week, and I'll see you in the next one.